Good morning, ladies and gentlemen. Welcome to the morning meeting of the ARMR Report. I'm Brett Rosenthal. We do this every morning, usually at 8:30. We're doing it today at 8 o'clock, so we can all join. We can have a little Q&A at the end. If you have any questions for me, you can fill up the question section of the message board. So, as always, this is a show about stock market investing, and it's the ARMR Investing Way. It's a three-stage process. We do our research. We put it on the whiteboard. We use algorithms to determine when to put capital at risk and when to protect it. We use stop losses to protect ourselves. So this is my journey. I'm sharing with you how I run my own personal capital. We're going to talk today about the type of market we're in and how we're building portfolios here at the ARMR Report from an investing point of view. So we're going to start there. We're going to look at the big picture of the ARMR algorithms that are, that have been sharing information that's been protecting capital since December 3rd of last year. So I'm going to go over those algorithms. We're going to look at what the algorithms think about or say about what the market will be doing next, right? So the way we approach this, and what I'm doing right now is the market just is trading kind of crazy, the futures. So for a second they were flat and then they were down 2%. Now they're back to flat. Okay. So just some crazy trading at 8 o'clock. It happens sometimes. So we're going to go over the algorithms and talk about, is it time to manage risk and continue to manage risk, or is it time to start putting capital to work and bottom fishing? All right. And then what we're going to do is drill down into day trading, because what we like to do is day trade the indexes. And there's two types of, markets that you can day trade. You've got the positive gamma risk monitor green type of market. And there's a whole set of rules and playbook for that. And then we try to apply that playbook to a much more difficult risk monitor red market. So we're going to discuss how we do that and a tactic that I call the flip trade to protect your day trading capital in a market like this. So before I dive in, don't forget my own personal journey. Do your own research, your own due diligence, figure out your own risk tolerance before executing anything you hear here or anywhere else on YouTube. If you want to subscribe to this channel, it's right down here. You can subscribe to the ARMR Report as well. Take a look, see if it fits your thought process. All right. So step one, every day I come to work and I try to determine how I want to put my capital to work, if I want to put capital to work. The first thing I do is I look at the risk monitor. So if we look here at the ARMR Report, there's these tiles up top. Right, we have our portfolios. We update that every day when we're adding or subtracting a stock to a portfolio. We let you know what the stock is, what price we've added, and what the stop losses are, what the targets are. Here's our whiteboard. So if we're going to add, we haven't added it yet, but these are the top stocks that we want to put into the portfolio, having done the research. And so when we get that shot, we take it. All exclusive videos are on this page, make it easy for you to find it. And right here is the risk monitor, okay? And when the risk monitor changes, what we do is we share with you what's happened. And what changes the risk monitor is the 7 algorithms that we've written for, these are probability algorithms, guys. So these are not neural networks. I'm not trying to guess what's going to happen next. All we're trying to do is say, when we get confluence, when all 7 indexes, and it's the S&P, the NASDAQ, the Dow, and the small cap are the big 4. And then we have the secondary indexes, the value, the momentum, and the IBD 50, okay, the innovators. So that covers the entire spectrum for us. We really boil it all down to that. Everything else is just noise to us. If those 7 are communicating a direction, we will execute, either add risk or protect it. So last December 3rd, all 7 were in what we call risk monitor red territory, which is highest cash balance that somebody wants to carry at that moment. Now we have 4 different portfolios. One is an index only portfolio that only follows those 7 indexes and uses the risk monitor to do it. So on that day, 100% cash. That has not changed since December 3rd. Okay. If the 4 indexes, the top 4, all give us a risk on entry point at the same time, but there's no confirmation with the secondary indexes. Give me a second. I need a little rocket fuel. God, coffee is such a wonderful thing. Okay. If we don't have that secondary confirmation. We might go risk monitor yellow. We might put some capital to work, but it's still a very kind of dicey situation, right? So since December 3rd, the index-only portfolio hasn't put any money to work. Then what we have is a regular investing portfolio focused on the whiteboard, having done research on companies. When we get risk monitor yellow or green, boom, we put capital to work in our favorite stocks, right? And then the third portfolio is a index day trading, swing trading portfolio. Doesn't buy individual stocks, just trades indexes and group ETFs. That's it for short-term gains, right? So it's always carrying a lot of cash over there. And then we have our dividend portfolio. I'm going to save that for another day. Totally different set of rules. So I'm not going to talk about that today. So a quick review of the indexes this morning, I think will help set our minds about what we should be doing this week. All right, so let's take a look. All right, this is the S&P. And you might, some of you who, ARMR insiders who are doing this with me every morning, you guys might get, kind of bored of going over this, but it really helps me because I want to see the big picture over and over again. We do it every morning. So it really sets me up for what's going to happen next. Here's a massive uptrend that was created by a Fed adding liquidity. When the Fed stopped adding liquidity and started to discuss raising rates and reducing liquidity, the market has broken down from that uptrend. So any thoughts of trying to buy a dip, because that worked for a couple of years of the Fed adding liquidity, needs to be put to rest. So what I want to share with you this morning is just stop trying to call the bottom. Stop trying to bottom fish. Stop trying to say, I think this is the moment. You're still living in the past. You're in a very volatile situation. Huge amounts of headline risk. Wicked swings in the market. The risk monitor's red. Negative gamma environment. Fed reducing liquidity. Why are you trying to bottom fish? It might have worked for a couple of years of the Fed buying everything in sight. And so you were bottom fishing with the Fed. That works. Stop doing that now. Now is the time to protect capital. The ARMR report's been saying that since December 3rd. We continue to say it. The risk monitor will change green again. It'll go yellow at some point, and we'll put some money to work. And I'll share with you when we're doing that. There may be tradable rallies in here. We're in a bear market. There will be tradable rallies. They'll last maybe 2 weeks. Okay? If you want to dance through those raindrops, feel free to do it. I'll probably be doing it with some of my capital. I have 4 portfolios set up for all of my capital. I have a certain amount of capital I'll do that with. But trying to establish long-term investment positions without any regard for stop losses because you think the market's at the bottom is going to be very detrimental to net worth. So take your time now to do research, work on your whiteboard, get yourself ready. There's 2 things that would get me to put capital to work. 1, risk monitor will change colors, which means the algorithms are telling us windows open to take risk. Number 2, the Fed gives us a timeline of what they're doing when. See, that's the big difference. At the December meeting, Fed Chair Powell said, we don't know what we're going to do come March. I think that was a January meeting, the January meeting. We don't know what we're going to do come March. Could increase 50 basis points, could not do it at all. Depends on what's going on. So all of a sudden, we don't know what the Fed's going to do. And that's why the market is suffering so much. If the Fed lays out at the next meeting, okay, we're raising 50 and we're going to do another whatever for the next X amount of months, and then we'll be done, the market probably bottoms because it can start discounting the future, which is what the market does. Right now, it doesn't know the future, and that's why it's trading like this, okay? So be on the lookout for news of the Fed shifting from opacity, which they're doing now. They're behaving like Volcker and Greenspan, which is to tell us nothing. Nobody knows anything. The market can't get its footing. If they shift back to a period of laying out step by step their plans, what happens is volatility gets crushed in a market where you know what the Fed's going to do. And that allows for positive gamma, risk monitor green, great time to put money to work. Okay. So until then, protect capital, work on your homework. If you feel compelled to put capital to work, smaller position sizes, stop losses, a must. Okay. So here's just taking a quick look, scrolling through. And by the way, that kind of looks like these look like head and shoulders patterns. These are like classic head and shoulders patterns. A shoulder here on the NASDAQ, a head here, a lower shoulder. This is classic. And when this breaks the neckline, I mean, it can get really, really, really ugly. You think it's ugly already. It's not. It can get really ugly. This is what really ugly looks like. This is the rising wedge, breakdown of the IBD 50, total implosion. We all know what the ARK funds are doing. You want to look at them just for the sheer sadness of it. You can, right? And there's a manager of this fund who refuses to admit that she's wrong. It's amazing to me. She comes on CNBC and says the market doesn't know what it's doing. I mean, talk about rule number one, the ARMR rules of the road. You can find them on the website. One of those rules, not number one, but one of my rules is you don't force your will on the market, right? And this is why Kathy Wood is showing us why we don't force our will on the market, because you get absolutely buried when you do that. Okay. So big picture, just looking at these things, we can just let's move over to major breakdown of a huge top in the small caps. These aren't even close to finishing off their corrections, not even close. And just to wrap up, here's the reason why. Okay. I shared this with you back in here. I said, when this is LQD, and let's just go over this real quick. LQD, and there's many different ways to look at it. You can look at junk bonds, high yield junk bonds. You can look at corporate investment grade bonds. I like to look at those because this LQD is the ETF the Fed was buying at the bottom. Remember, it was unprecedented, never done it before in history. They're going to start buying an ETF of corporate bonds. So I follow this closely. The first breakdown, and I talked to you guys about this here, was going to take down the ARK type investments, right? That's what it did. That first breakdown was the shot across the bow. Something's wrong with the market. This was last February, and the ARK, innovator type stocks got obliterated. All right. And then they held up the bond market for a while. And on this breakdown here, what I wrote for you, and I think back on probably December 3rd when the risk monitor went red, what we talked about was this breakdown coming here is going to come after the Qs, which is exactly what's happening now. So what we need to see is this precipitous decline to stop before we start hoping or thinking that the market is close to a bottom. What we want to see is corporate bonds, which, by the way, don't forget, write it down, put it on your bulletin board above your head. Bonds lead stocks. Debt leads equity. It's always like that. Okay. So what you need is for debt to find a level where it's comfortable and begins to build a base. Equity will still be going down, but you'll start to see a base form in debt, and you'll say, ooh, now maybe we can start bottom fishing. Okay. So those are my thoughts, big picture on the market. Risk monitor is not going to change today. And just to wrap up, this big picture thought on investing, there's different ways to run money. Obviously, I don't profess to have the only right way of running money. I'm sharing with you what I do for my own personal capital. Okay. It works for me over 30 years of doing this, but everyone has their way. I would just say that there's nothing wrong with simply carrying a lot of cash and waiting for your moment. You don't have to be invested. I know, a lot of the investment community drills into your head, you have to be invested. You know why they do that? Because they usually make money off of your investments. They're either making commissions, or they're collecting a fee, or whatever they're doing. Okay. I'm just sharing with you what I do in my own personal capital. I don't have an axe to grind here. It doesn't do me any favors for you to trade. I don't make any money off of you trading. And so I'm just sharing with you, there's nothing wrong with holding a lot of cash in a market like this and doing nothing. You're worried about your retirement. I have to build up my net worth. You know what you have to do first? It's protect your net worth. Then the window will open. Then you put the money to work. So don't feel like you have to be in there slugging it out day after day, banging your head against a wall in a very difficult market. Okay? What I like to say is different styles of management. My dividend-only portfolio, I own those stocks for better or worse. And as long as they don't violate weekly stop losses, I leave them alone. Portfolio runs up, portfolio runs down, crazy, whatever. Right now, we're making a lot of money there because we're focused on commodities and energy. But there'll be times when that portfolio doesn't perform like this. Okay, it underperforms. I don't care. That's that segment. The rest of my capital, I have a lot of cash waiting for opportunities. It's okay to be patient. This is a bear market. The risk monitor is red. This is where we're making money. So I'm going to share with you a couple ideas that I might add back to the portfolio. It's very tricky right now because the volatility is so high. So I'm trading in and out of some of these things. And for those of you following the ARMR report, ARMR insiders that are thinking, boy, this is a lot of trading. It is right now. That's the market we're in. If you don't like it, don't invest. Don't trade. Wait for risk monitor green, put capital to work, then you won't be trading as much. When the risk monitor is green and it's positive gamma, okay, we can put money to work. Our stops don't get hit. Market starts to go in an uptrend. Volatility starts to get crushed. We make investments. They stay in the portfolio for a long period of time. So it's the type of market we're in that forces us to swing trade, to take stops, real quick stops. I mean, my stops are ridiculously tight. Put a position on. If it pops, great. I make a little bit of money. If it doesn't, I go back to cash. Okay? But if that process makes you uncomfortable, stop doing it. Just be patient. There'll be another risk monitor green. I don't know where, but it's going to happen. And you'll have all this capital to put to work while everyone else is destroyed. And you'll be picking up these unbelievable entry points. Okay? So consider that. Now, here are some stocks that are working in our portfolio. Okay? We are loaded to the gills, for instance, in pipeline stocks. And they're not running away yet. Alarian is an easy way to do it. It's an ETF, right? AMLP, 7% yield. 7% yield? Boy, I'll take that all day long. I don't even care if the stock goes up. If it just goes sideways all year, I get 7% of my dividend money. I'm a winner. True, we bought it down here and it popped out. I think maybe we bought it up here and it popped up. Okay, but it's not that far away from where we bought it. And then these are some of our favorite names that we have also individually. Here's Williams. You can see the green box is where we bought it. So I'm not telling you to buy it now, but just as some thoughts, we own some Exxon. So we're heavily into energy. The green box is where we bought it. So I'm not buying Exxon up here. Okay, we own some Kinder Morgan. Kinder Morgan, we own right around here. I mean, we bought it right in here. So I think we bought it actually right here. It broke down, popped back up, right about where we bought it. Not every stock's going to go up in your dividend portfolio. If the net worth of that portfolio is equal to or greater than what you put to work and you're collecting a 7% yield, you win. Enbridge, we put that in on here. Okay. So commodities are working for us. You want to know where to invest right now. You're asking that question. The risk monitor is red. I won't put capital to work in technology names and all these other things. But this is a bull market in commodities. Russia only exacerbates that situation. And by the way, those of you curious about what I think on Russia, okay, I don't think much. I think it's an entire sideshow shenanigan. We're in a negative gamma market, risk monitor red. So every little news story can rip the market lower or higher. Quite frankly, I can't wait for that Russia story to die down. It's just political theater to me. That's what I think. I could be wrong. There could be some crazy war that breaks out. I don't buy it. I'll have to believe it when I see it. Okay. It's just ridiculous political shenanigans that are muddying the waters. That's what I think. Okay. From an investment point of view, I'm sorry for the people of Ukraine, whatever's going on there. I'm just talking about from an investing point of view. All kinds of headlines, all kinds of warmongering, probably that won't be the result. That's my bottom line. And I don't use anything about that to make investment decisions. It just muddies the water when I'm trying to trade, okay? So it kind of annoys me. When the risk monitor is red and there's inflation and the Fed's raising rates, the best place to put money is going to be here. Gold and silver. We've been building these positions for the last month or so. Sprott physical gold is now breaking out. Sprott physical silver hasn't even started yet. Okay. So let me just take this moment to share a quick thought with you. I had a debate with a lot of you over Bitcoin over the last couple of months. And I was only too happy to tell you and admit that I missed the run up. I get it. Okay. I missed the run up. Okay. And I'll own that. Number one. Number two, I think there is a place for cryptocurrency in a portfolio. I've learned that. So that's great. Okay. But number three, when Bitcoin was trading above 60,000 and they were issuing the ability for an ETF to start trading, I told you then that cryptocurrencies are a risk asset. I heard a lot of people all over Twitter, whatnot, talking about how Bitcoin's the new gold. We discussed it then. I said that is absolutely incorrect. Gold is a hedge when there are issues around the world. Gold is a hedge. Bitcoin is not a hedge. It's a risk asset of the ultimate order. It's an innovator stock. Let's be honest. That's what crypto is. It's an innovator idea. Will it be a replacement some point decades from now for gold? Who knows? We'll debate it then. But right now, and I shared this with you when Bitcoin was above $60,000 a Bitcoin. I said, this is not a hedge. This is not the new gold. It's ridiculous. It's a risk asset and a high risk asset at that. So when the Fed reduces liquidity and they wreck innovator stocks, they will wreck crypto. This is exactly what's happened now. So I think on the one hand, I totally missed the run up. On the other hand, I hope I helped some of you protect capital so you didn't give it all away on the way down. And by the way, that sell-off is continuing and likely to get worse. Okay? And unfortunately, I would say that now I would finally I would agree, and I say this tongue in cheek, okay, that Bitcoin is the new gold now. It is the new gold. And the reason I say it's the new gold now is think about it. Governments can't stand Bitcoin. Central banks, investment banks hate Bitcoin, right? They started trading futures on Bitcoin. People thought that was great. That was the beginning of the end for Bitcoin, right? They allowed an ETF to start trading. Oh, everyone thought that was the greatest thing ever. $65,000 a Bitcoin at the time. And I said to you all, it's the worst thing you can do to Bitcoin is start trading an ETF. And I said, ask me how I know. It's because I'm a metals investor. I'm a gold and silver guy. Okay. And futures, options, and ETFs are all a way to siphon off real physical buying of Bitcoin. And it's a way to allow for a manipulation scheme by governments to suppress the price. So congratulations, the Bitcoin owners now own the new gold, an asset that governments want to manipulate price on, and they have the tools to do it. So the huge run-up in Bitcoin happened because there were not futures and options that people were trading. And for a while, there were no futures and options, right? There was no ETF right? So very hard to manipulate it. Now you're in a world where central banks, governments, investment banks, hey, they can manipulate it like crazy. And they'll do it. And they'll do a price suppression scheme just like they did with the precious metals, right? Now the flip side is gold and silver. I say this is the time for gold and silver. I've been saying this for a while. We just started to see the move the last couple of weeks. And if you think about it, gold is the new Bitcoin. And I say that again, tongue in cheek. I'm just smiling and having fun with you guys, okay? I'm just having fun here. But if you think about it, gold is now, if you look at the balance sheets of Goldman Sachs, JP Morgan, they have huge gold and silver positions, physical. They've been accumulating them during the price suppression scheme. They've been accumulating the physical for a couple of years. Central banks have been accumulating the physical for a couple of years, all in advance of the Basel III rules that went into effect January of this year, making gold a tier 1 asset. What that means is banks have capital requirements. They have to have a certain amount of capital in tier 1 assets. Up until this year, they were able to have US treasuries and other sovereign debt, right? Cash, right? And now they're allowed to carry gold on their balance sheet towards their capital requirements. So now we're in a world where inflation is getting out of hand. Financial world is unstable. Debts are out of control. Governments, central banks, and investment banks have huge hoards of physical. And so now we're entering a price enhancement scheme. You allow gold and silver prices to go up, and it really helps governments and banks to balance the books. This is the beginning of a commodity super cycle. Gold and silver will be a major part of it. It's why it's a major part of our portfolio. I also like Rio Tinto, BHP. I want to get myself back into these names. We've traded them aggressively. We've traded them a couple times. This looks like a little cup and handle breaking out again on BHP. I'd like to get a hold of that again. BHP and even Valley, right? We trade all three of these. So these are some of the names at the top of the list. I saw a story drop at the end of the day on Friday that the U.S. government wants to enhance their rare earths. Now, I mean, every time that story comes out, it tends to kind of be the top of these stocks. But who knows? We're trading MP. Every time there's a hit piece on a short article that comes out, it drops. We want to buy it, it goes up. Short article comes out, it drops to the bottom, we buy it, it starts to go up. So we made money trading MP. Maybe I'd like to put that back in the portfolio. Okay, so these are some of the names at the top of the list. Now, I do want to make a shout out to an ARMR Insider, Brian B. Brian B. This one's for you, brother. Well done. What a great call on MTOR. It's being bought by Cummins this morning. The stock's up 44%. Well done, brother. Got to get that in. All right. So those are some of my ideas from an investing standpoint where our head is. Let's just jump right into day trading real quick, and then I'm going to get to your questions. We're getting to the end of the half hour here, and I want to get to some of your questions if you've got any for today's action. I want to go over the flip trade with you. So what we're going to talk about here is how we trade in a Risk Monitor Red, high gamma, high news event driven market. Number one, first thing I would say, you don't have to trade this market. It's very difficult. People who are having trouble day trading right now, it's not your fault. You're in a very difficult market. You have to change the way you trade. I think David R., he's making some money trading this market. He gets in quick, gets out quick, makes his nut. So there's different ways to trade. In a very volatile market, you get your trigger, you buy it, it pops over a 6 to 9 minute window, and you're done. There's nothing wrong with trading like that. So there's different ways to trade, and I commend you guys who are trading that way. We all have to find the way that fits us. I share with you my ARMR day trading way, right? And which is different. And what I do in a market like this is I employ a flip trading process to me, there's always information the market's telling us. If we get long the market and it hits a stop, the information is the market's going lower, because the strategy that I employ when I get a long risk on opportunity in the S&P has a high probability of working in a normal market. So if the stop is hit, telling me the market's abnormal and it's going lower, and I will flip short. And literally right now what I'm doing is putting a long trade on the S&P, and I'm putting sell stops into the market on the Qs and the small cap. So if I'm hitting my stop on the S&P, in all likelihood, I'm at the very same time getting short. Like, it's instantaneous. The object of those shorts is not to be a hero and hope I make a fortune on the short side. That's not what I'm trying to do. But what I am doing, and what is working almost every day this happens, is that the shorts are making up for any losses on the long side. My P&L is break even, and I hop on the next long trade. Where I'm comfortable is capturing alpha. When the market's down big in the morning, down big anytime, right? And I have a lot of cash, I have alpha. What I want to do is put money to work coming off that bottom for a day trade to capture the alpha. And very often there's mean reversions during the day, and that's what I like to trade. So the market sells off below the volume weighted average price. I get one of my 5 ARMR buy signals, which I share with you guys on the live trading desk. And I say, here's our entry point. This is a high probability entry. In a risk monitor green, positive gamma environment, this works, like 90% of the time, okay? So in this environment, we don't know what the next headline is going to be. So it's much more difficult. Either A, we shouldn't trade the strategy. That's fine. You don't have to trade it. Or B, what I like to do, and the reason I keep trading it, is there are massive up days. In a bear market, the biggest one-day rallies occur in a bear market. That's a statistical fact. So that's why I keep searching for that. And if I can keep my P&L break even, and on Friday we actually made money. If you flip trade correctly and then you capture the upswing, you end up making money. Not a lot of money. It was a lot of hard work, but we made money. So the object on the flip trade, I'm going to walk you through it, is to protect your P&L so you're there for the trade later in the day that tries to revert to the mean, which is the money trade for me. So let me show you what I mean. All right. So you're looking at the S&P and the NASDAQ. We're also short small caps. I'm just going to show you these two for now, because just share the screen, make it big enough. So I'm always looking long the S&P, and I go short the NASDAQ and the small cap. So these green boxes are 2 triggers, right? 3 triggers. This was a trigger to get long in the morning. It failed. So we get long right in here on the S&P. And if you go over here, you'll see this pink box right here is where we get short the NASDAQ. So whatever money we might lose in the morning, which is small, we have a very tight stop, because the trades that work never challenge the stop. So it hits the stop, we have a small loss. We get short, boom, real nice trade on the short side, right? Then we have another reversal trigger. We put a trade on. It breaks right here, and you can go over to the pink box. Now we're short. So when we're getting stopped out of the long side, we flip short. It sells off, makes a new low, and we're booking the profit there. The key to that is I'm not looking to make a fortune on that short trade. All I'm looking to do is cover whatever loss I had on the long side. Sometimes you get lucky and the whole thing implodes and you have a big day short, but I'm not looking for that. I'm just looking to capture what I need to keep my P&L even. Look, if I can make some money on the shorts, that's great. Make some money, okay? But if I can just keep the P&L even on the flip trade, I'm a winner. And it allows me to put that third trade on during the day, okay? And the third trade comes right here, and we captured the upside on the third trade, which turns our entire day profitable. See, risk monitor green, positive gamma, there's usually 1 trade, maybe 2 trades a day, but usually 1. You get the signal, you get the trade, you put it on, market goes up, you make your money, you're done trading for the day. You guys, insiders, been trading with me. You know what I'm talking about. Those are the days we had many of those days, right? This market, there can literally be 3 long entry points. You never know which one's going to be the one that works. So I try each and I flip to protect, okay? And that's how we're keeping P&L steady. like I said, Friday we made money. Other flip days we've made a lot of money because the short side implodes, and so you end up capturing a larger alpha. But just keep in mind what you're looking for there. Don't fall in love with the short side, is what I'm trying to say this morning. More money will be made on the long side when we get it right. So I'm constantly searching for that. So anyway, that's what we're doing on the trading desk. We'll be doing it again today. The market's going to open down, I don't know, 0.5% on the S&P, something like that. Market will probably sell. It was down big overnight. So, looking for the sell-off, then look to put the trades on. This is my last thought, and then I'll get to any Q&A you might have. This is very important. Maybe it requires some more coffee. But I want you guys to really think about this, because I work with a lot of people, a lot of ARMR insiders, and we're all at different levels of net worth, okay, and levels of investing experience, okay. And so this is very important to me that you all understand this. When you're day trading, it is imperative. It's imperative that you have enough capital in your account so that you're not staring at the P&L. Now, this is true for all of us. It's one of the rules, the ARMR rules of the road. You can't look at your P&L when you're trading. Okay? Never look at your P&L during the day when you're trading. What you want to do is execute a strategy. You got the ARMR day trading playbook. We know what the strategy is. We come into the day, we see it, we execute it. Put your positions on, know what your stops are, execute it. Get to the end of the day, look at the P&L. If you execute the strategy correctly, you come out ahead. Okay? Some days you lose money, it's okay. Maybe work on your execution, maybe work on your position sizes. But do not stare at your P&L all day. So that's true for all of us, but particularly true for somebody new to the business who is underfunding their account, so that you're running into pattern day trading rule problems. You cannot run money that way. You cannot just put in the minimum required and then sweat every single second of a trade because you know if it goes below this level, I'm going to have to put more money up because I'm a pattern day trader. You can't do that to yourself. It'll be so difficult to make money. I always suggest that somebody start a day trading account with twice as much capital that is required. Twice as much. You don't have to use it all, but you put twice as much into the account so that you don't have to sit there every single day worried about whether or not you're going to slip below a certain number. The only way to day trade successfully is to clear your mind and execute a strategy with no emotion. And if you're worried about bumping up against a pattern day trader rule, man, the emotions are all the way up here, and it's going to be very hard to execute anything. So if you say to me, I don't have that kind of scratch to put twice as much, well then, respectfully, I would say don't day trade right now. Use a simulation account. Get real good at simulated trading. Use your capital to invest, to swing trade. But don't pull your hair out day trading, staring at the P&L all day, hoping it doesn't go below a certain figure. Okay? All right. Those are my thoughts for this morning. Let's get to some questions. Anybody's got any questions? And if not, I've got to get the rest of our day set up here. Wanted to mention, oh yeah. Take a look at, here are some of the top names on our, actually these are in our portfolio right now, John. So we own Wheaton Precious Metals. We actually own Wheaton. So I'm with you 100% on Wheaton. We own it right in here. Our top four names are Wheaton. We own shares of Newmont right in here. We own shares of Gold, Barrick Gold right down in here. Okay, and we own Franco-Nevada. Those are our favorite four names. Now, at the end of the week last week, we took a piece of a position in Agnico Eagle. It's far behind its brethren, as you can see, it's still in a downtrend here. They made an acquisition of Kirkland Lake. I think it's a great acquisition. It's been taking time for them to get through that, it looks like. Nobody's given them the value on that, in my opinion. So I think if it could break the downtrend in here, this stock could catch up to the other names. So those are our top 5 names in the space. I do not use options or spreads. I don't use options or spreads. Do I ever use options? I mean, have I ever bought options? Yes. I don't trade them spreads and those types of things. I don't trade options. When would I buy an option? A couple years ago, right before the blue wave, right before Biden was elected, cannabis stocks had been destroyed, and you could buy canopy growth leaps, right? Long dated options for almost nothing in time. It was almost all intrinsic value. It was incredible. So I bought some of those, and we had a nice run on those, right? Democrats won, and all of a sudden it was a green wave, and the stocks went berserk, and I owned options there. So I'll own options when I think they're wildly mispriced on an investment that I like, but I don't trade options. Do I ever sell options or buy options naked? All right, you make a good point there. Once in a blue moon in my dividend portfolio, I might write options. So I might enhance my dividend yield, which is the most conservative way to use options, right? So I have an asset, it runs. I'll give you an example. Here's a good example of this. Let's say Exxon. Exxon had we bought it here and had a huge run. It's 4 standard deviations away from the 200-day, which is usually the max a stock will run. Okay, a stock like Exxon, that's usually the max before it has to consolidate. So when it's up here at the 4th standard deviation, and I could write an 80 call out 3 months and collect some yield, and then add to my 5.5% yield, I might do that. In fact, we did that last year in Pfizer. Pfizer exploded up in here, and we wrote the calls, and the thing came all the way back down, and those calls expired worthless. We collected that yield, and then Pfizer took off again. So every now and then I'll write calls. I'm never naked. Never. I don't need that kind of risk. I can't sleep at night. I can't sleep at night, that kind of risk. So I don't do that. Are you buying, Rick? Okay. JJ boy. So we still own HP. It's my number 1 name in the drilling space. So we own HP. I traded rig out on Friday. I don't want to carry the risk, and that's clearly a pattern that broke down. So it simply hit our stop. I'm not going to carry it over the weekend. I know it's up this morning because price of oil is up a bit, and I might buy it back. I love rig and I love Neighbors. Okay, Neighbors is my other favorite name in the space. So rig, Neighbors, and HP. HP I'm holding on to for dear life with a more lenient stop because it's my favorite drilling name. So, the stop now is break even. I bought it. It popped. I'm not going to trade it. I'm trying to stay with it. But I won't lose money on it. Rig is much more volatile. It's on top of my whiteboard. I'll look for the next entry point. It won't be this morning's gap up. I won't be doing that. But I'll look for the next entry point. Neighbors is my 3rd drilling name that I like. XOP, I honestly, I would rather the drilling stocks. I can't tell what's going on here in this chart of XOP, and I don't own it right now. I'm actually, truth be told, I used XOP on Friday as a hedge for the rest of my energy portfolio. So I've got Exxon, I got the pipelines, I got driller stocks, and I'm actually shorting XOP intraday to hedge. We made money short XOP on a day trade on Friday as a pure hedge for my energy portfolio. So I'm not really that interested in XOP, but I might go long again. I don't know. Right now, I want to carry a max cash position. So if we were to change the risk monitor color, if the ridiculous Russia news were to die down, maybe I could make investments that make more sense. But at the moment, we're swinging pillar to post with crazy stories, and it makes it very difficult to put money to work. And that's true for energy stocks. If there's positive resolution to the Russia story, energy's down huge. I mean, it's ridiculous. So I'm not putting that money to work right now. Any other questions you guys have? If not, I'm going to split here. Let me see if there's anything cooking. Here's a couple of thoughts. Yeah, thanks for bringing this up. So a couple more names on my list, and then I think we're going to split here. I just wanted to share with you. So Deere's at the top of my list. They announced earnings, the stock got whacked, the market was getting crushed. I think it's a great idea with a great chart pattern and the right time for agricultural stocks. So I got my eye on Deere. I'd like to add that back to the portfolio. I'd like to add shares of Caterpillar, but it's breaking down, so there's no reason to do that right now. And I have my eye on Intrepid Potash to be added back to the portfolio as well. All right, so those are a couple names at the top of my list. Looks like Deere's breaking down this morning. Don't forget MSOS. I know you guys are always asking me about MSOS. So right now I'm out of the stock. This is just not a market to carry MSOS. It had it did everything it could possibly do, and then the market just imploded Friday, and it closed below the 50. So I shared with you guys, I'm not carrying MSOS if it closes below the 50. Okay, if there's a weekly close above the 50, I will be long MSOS. So write it down. MSOS closes above the 50-day moving average on a weekly level, the ARMR report will be long. I'm looking for the entry there. But when the small cap index is imploding, it's going to be impossible to make money on MSOS, without some rule change. And that's not going to happen in the middle of the night. So safe bank. I'm not going to wake up and all of a sudden safe banking's happened. Okay, so John, I don't know if you're an ARMR Insider. Consider joining, and certainly we go over these questions all day in the Slack room, and so I try to on the live trading desk, I'm sharing how I set up my stops throughout the day. Okay, so it's hard for me to answer that question in the next 30 seconds, and we've got to split, but there's many different rules to how I like to set up a stop. I'll share this one very important one that works really well for me. Go back and look at all of your major successes. I submit to you that very few, if any, ever went below the low of the day you bought them. They say in the market, you make your money when you buy it, not when you sell it. Okay? So if you're buying right, the low of the day you bought it should be the stop. If you're buying right and you're in the right market, it will never go below the low of that day. And you might have to trade out of some things until you get good at buying right. This is what we do with algorithms, help us buy right. Okay. But over time, you'll learn. You'll look at your best position and say, God, I bought that perfect. Well, then I submit to you, why are you buying everything else? Look for those entry points and only buy those entry points and use the low of that day as your stop. That's my thought for you. Are you late on precious metals? Will you get stopped out? Hey, man, I can't help you with that. I've been trading precious metals for a long time. Sometimes I get stopped out. It's true. At the ARMR report, we were buying precious metals, weeks ago. So we were buying gold and silver down in here. So I'm not coming on here and I'm not giving you any recommendation of how to put your money to work, right? This is how I put my money to work. You got to do your own due diligence, figure out what your risk tolerance is. If I was to be putting money to work now in precious metals, the stop would be a lot lower. It can't be the low of today because the real entry point's down here. See? So the real entry point on gold, for instance, is down in here, the green box. So right in here was the stop. We were buying right close to the stop. If you're buying up here, you can't use the low of today as your stop because really the real stop is down here, the 200-day and the 50-day moving average that have just turned up. So anybody buying now, and just to reiterate, that's not anybody at the ARMR report. We're not buying precious metal stocks now. We already own a full allotment. I have all the precious metals I can stand right now. Okay. If somebody's buying them now and you recognize where the real stop is, which is a lot lower, then the position size has to be commensurate to the risk. So you might just put a quarter of the position size on. And as it comes down towards the stop, you could build your position size up. In this case, the stop's the 50-day or the 200-day moving average. Okay. And if the thing just skyrockets, at least you have a piece on. So that's one way to look at it. Is the bottom in on Roblox? Man, the bottom's not in on anything right now. Okay. There's no way for me to know that. First of all, I wouldn't possibly know that. And second of all, the bottom is not in. And I mean, I don't, forgive me if this sounds however it may sound, but man, I started this whole conversation off this morning by saying, stop bottom fishing. Just stop it. You've got a market that's imploding. Innovative stocks are getting wiped out. It's going to take months for these stocks to build a healthy base that we can buy. Are there going to be some wild swings in there? Sure. You could try to make some money on the wild swings. I do it. Every now and then I go in there and buy Roblox, trade it out. But when it comes to an investment, it's going to take months for this thing to build a base. Weeks at least. And what we really need is a risk monitor to go green. Roblox won't be the first stock to go up when the risk monitor goes green. I'll tell you that right now. It'll be big cap, NVIDIA, Microsoft, Apple. Those will be the first names that turn. And then these stocks will follow weeks later. Okay? So be patient. Be patient. All right, guys. I appreciate your time today. I look forward to seeing all the ARMR Insiders on the live trading desk. We'll get that underway at 9:15. What we'll be doing is setting up our yeah, that is the bottom. People stop asking. That's the bottom. You're right. Yeah, exactly. So look, anyway, so the live trading desk, 9:15. I'll see you guys all over there. We'll be setting up our spot gamma location so we can day trade the indexes. Everybody else, I'll see you in the Slack room, all ARMR Insiders in the Slack room all day, sharing ideas and information. And one more shout out to ARMR Insider, Brian B. Well done, brother. Well done on MTOR. Big winner today. All right. Take care, everybody. Have a great day.